perfect students. Civic Education with Knowledge World Academy. Your perfect tutor, Mr. Gilbert Sijo here. Okay, so we are still looking at economic and social development. But in this video, we are going to focus on two things: insurance and work culture. Insurance and work culture. In the previous video, we looked at banking. Okay, so what is insurance? So insurance is the system of protection against all forms of risks. Protection against all forms of risks. That is what we call insurance. Now, there are two things here. We have the insurance company and you, the person looking for the insurance. So the insurance company is called the insurer or the underwriter, whereas the person insuring is called the insured. So you have to know these terms because we'll be using them over and over again in this topic. The money that the insured pays is called the premiums. The money that you pay to the insurance company is called the premiums. The insurance is based on the principle of pooling risks. It's like we are a lot of people looking for insurance. Now, this is how it is. Let's say, for example, you insure your vehicle, you pay money there, but your vehicle does not encounter any accident, or the risk that you insured against does not occur. Then your money will be used to compensate others who are facing such challenges. So it's like we are putting the risks together. Then whoever faces or encounters a challenge is the one who will be compensated. The contract signed is called an insurance policy. You will sign a contract with the insurance company, which is called the insurance policy. Now, the insurance company has got four principles of insurance. So there are four principles that guide the insurance company. The first one is insurable interest. Insurable interest. So this principle states that only a person will suffer the loss should the property get damaged is supposed or is allowed to insure that property. Hence, you are not allowed to insure someone's property, either the property of your father, property of any relative. You are not allowed to insure that property because you will not suffer any loss should that property get damaged. And you may also be tempted to cause damage so that you can be compensated, since you're not the one who will face the loss. So that is insurable interest. Only a property which is yours can be insured by you. Are we together here? The second one is the principle of utmost good faith. Utmost good faith. So this one states that there should be maximum honesty from both the insurer and the insured. When we talk about the insurer, we are talking about the insurance company itself. The insured is that person who is signing an insurance policy. So there should be maximum honesty. You must tell the insurance company the truth. If you are insuring your house, tell them your house has the floor of maybe cement screed. Don't tell them it is made up of tiles when the house has cement screed. Don't tell the insurance company that your house has got the roof of asbestos, meanwhile your house is made up of iron sheets. So you have to tell the insurance company the truth so that this will help them calculate the premiums very well. That is utmost good faith. The third one is the principle of indemnity. So the principle of indemnity says that the insurance company only aims at restoring the insured to his or her position, his or her original position before the risk happened. So you won't make any profit here. What am I talking about? For example, you insured your vehicle against accident. Then it gets damaged in an accident just as you insured it. So the insurance company will compensate you. They'll give you money to buy a new vehicle, or they'll buy a new vehicle for you. But that damaged vehicle will be gotten by the insurance. They'll take it, because if they buy you a new vehicle and they leave that damaged one with you, then you have made a profit. You have two vehicles now, a new one and a damaged one. So you're not supposed to make any profit. The insurance company will give you a new car and take the damaged one. That is the principle of indemnity. Then the last one is the principle of subrogation. The principle of subrogation. So the insurance company, under this principle of subrogation, can only compensate a risk that was insured. A risk that was insured. What do we mean a risk that was insured? Let's say, for example, you insured your house against accidental fire. You insured your house against accidental fire. Then you get drunk on Christmas and you set your house on fire. The insurance company will never compensate you, because that was not the risk insured. You said accidental fire, not whereby you just set your house on fire and you expect the insurance company to compensate you. That is not possible. So insurable interest, your property is the only thing that we can insure. Utmost good faith, honesty. Indemnity, original position. Subrogation, the risk insured is the only risk that can be compensated by the insurance company. I hope we are together. Let's talk about the insurable and non-insurable risks. So we have two types of risks. There are risks which can be insured and the risks which cannot be insured. Insurable risks are events or losses which can be insured. They are easily traceable. It is easy to calculate premiums for them. For example, destruction of property or stock by fire. So insuring a risk which is fire here, because fire can come from nowhere. There is accidental fire. So fire here. Then goods in transit, you can also insure the goods in transit. Motor vehicles, you can also insure a motor vehicle. Crops, etc., etc. But non-insurable risks are losses which cannot be insured. For example, loss of business due to bad management or fashion change. Bad management, this is not a risk. It's just your recklessness that has led to this loss. So this risk cannot be insured. So these are the two types of risks: insurable risks and non-insurable risks. Now let us talk about the types of insurance cover, the types of insurance policies. So the first one is motor vehicle insurance policy. So under the motor vehicle insurance policy, the insurance company compensates the insured should his or her vehicle get damaged through an accident or fire. The insurance company will compensate the insured. We're talking about a vehicle here. So you insure your vehicle, you'll be paying premiums. Then if your vehicle gets damaged in an accident or by theft, maybe they just steal it, you can be compensated. They can buy a new one for you. Now, there are three types of motor vehicle insurance policy. We have third-party insurance, full third-party, and comprehensive insurance. So what is third-party insurance? So this third-party insurance is compulsory under the Road Traffic Act. It is compulsory. No license, no driver's license can be granted minus having the third-party insurance. You must have this insurance, this type of insurance cover. So why are we saying third party? Who is the first party? Who is the second party? So the insurer and the insured are the first two parties. The insurance company and the person who is insuring are the first two parties. Anyone else apart from the two is the third party. Anyone else apart from the two is the third party. So here, let's say the car knocks down a pedestrian on the road. If you insured your car with third-party insurance, the insurance company will compensate or will cover the medical expenses of that injured pedestrian. Will cover the medical expenses, but not the damaged property of the pedestrian. Get me cleared here. The insurance company will only cover the medical expenses of that third party, that pedestrian, that person who has been knocked by the car. Now, let's say that person had maybe goods or any property such as a laptop or a phone. Now, when he or she was knocked down by the car, even the laptop was also damaged. So the insurance company is not going to cater for the laptop. It will only cover the medical expenses of that person who was injured. This is under third-party insurance. Now, we also have full third party. Full third party is not compulsory. Only third party is the one which is compulsory. So for full third party, the insurance company will cover for the medical expenses of the third party and his or her property. Now, in this case, the laptop will also be compensated. I hope you are able to get the difference here. I gave an example of the car knocking down a pedestrian on the road. Then that pedestrian, that person had a laptop. So when he was hit by the car, the laptop also got damaged. So under third-party insurance, the insurance company will only cater for the medical expenses of that person, minus compensating the laptop. But under full third-party insurance, the insurance company will cater for both the medical expenses and the laptop. They will compensate. But for full third-party, the passengers that are in the car are not covered. Should they get injured in an accident, they are not covered. So we also have this other one now, which covers everything, the comprehensive insurance. Comprehensive insurance covers everything: the damages to the vehicle, the passengers, the car owner, the third party's property. Everything is covered by the what? By the comprehensive insurance. So even the premiums are high for this one. That is how it is. Remember, I said premiums is the money paid by the insured to the insurer. So comprehensive insurance covers everything. These are the three types of motor vehicle insurance. So when you go to the insurance company there, choose the one which is suitable for you. The second type of insurance policy that we have, remember, those were just types of motor vehicle insurance, is the employer's liability. We also have the employer's liability. So here the employer insures the what? The workers or the employees. Should they get injured or sick or die while on duty, this is done by the what? By the employer. Then we also have fidelity guarantee policy. This one is taken by employers for the employees who handle finances. Employees who handle finances. This one is for employees who handle finances. You can also insure bad debts. Should your customers fail to pay their debts, the insurance company will come in and compensate you. Those are bad debts. Then we have life assurance. Why do we call it life assurance and not life insurance? So check. When we say life assurance, here we're talking about an event which will definitely occur, because whether you are educated or not, you know these things or not, you will die. So life assurance, we assure against an event which will definitely occur, which is death. For these others, when you are insuring your vehicle against an accident, how are you sure that that accident will happen? What if the accident will not happen? For death, it is a definite thing. That's why we say life assurance and not life insurance. We would say life insurance if we are not sure whether death will occur or not. Now, since we are sure that death will come, then it is called life assurance. That's why it's different from these others. Now, there are three types of life assurance. The first one is whole life assurance. So under whole life assurance, the insured will pay premiums to the insurer or to the insurance company. Then that money will be given to his or her relatives after death. After you die, your relatives will benefit from those premiums you were paying to the insurance company. There is no specific period of insuring here. Whether you die after 50 years, whether you die after 60 years, as long as you die, the money will be given to what? To your relatives. Then we also have terms policy. So terms policy is a bit tricky. You insure or you assure your life for a specific period of time. Maybe let me say you assure your life for 20 years. You assure your life for 20 years. So you pay a specific sum of money to the insurance company. So if you die within the 20 years, the money will be given to your relatives. But if you do not die within 20 years, the money will not be given to anyone. The money won't be given to anyone. Get this one clear here. So if you die within the 20 years, they will give you the money. They will give the relatives actually. But if you don't die within the 20 years which you assured your life, the money will not be given to any relative of yours. That one has just gone like that to the insurance company. We also have life endowment policy. So there is a small difference between life endowment policy and terms policy. So just to remind you, I've said terms policy, if you die within the 20 years, the 20 years is just an example. I don't say it's the specific number of years. If you die within the 20 years, which you assured, the money will be given to your relatives. But if you do not die within the 20 years, which is the assured period, no money will be given to your relatives. That is under terms policy. But for life endowment policy, if you die within the 20 years, money will be given to your relatives. Again, if you live beyond the 20 years, you don't die within the assured period, money will also be given to your relatives or to you. They will give you your money. So it's just that for terms policy, if you don't die, they won't give you the money. But for life endowment policy, even if you do not die, money will be given. So this one is better. Let us talk about work culture. We said we'll talk about two things, insurance and work culture. So what is work culture? Work culture is the attitude of people towards work, which can either be negative or positive. So what is positive work culture? Here are the characteristics of positive work culture. Number one, a person who has positive work culture works hard to meet productivity targets within a given time. Say, do this assignment in 1 week. A person who has positive work culture will make sure that he or she finishes the assignment within the given time. This person also does not wait for supervision, feels committed to work, and uses initiative. If you see this in your employee, if you are an employer, just know that this person has got positive work culture. So negative work culture is just the opposite of this one. It's just the opposite of these points here. So the person who has negative work culture does not work hard to meet productivity targets, and often they do not follow deadlines. Does not wait for supervision. Negative, they wait for supervision. Every time is to tell them, no, do this, do this, do this. Negative work culture. Feels committed to work. Positive, feels committed to work. Negative, they don't feel committed to work. What they only want is the salary. Uses initiative. Positive uses initiative. Negative, they can't use any initiative. They'll just be following whatever is there. That is work culture, positive or negative. So you just need to know this, the positive ones. Negative, you just do the opposite of the positive work culture. Great. Now, what is the importance of positive work culture? Positive work culture increases the country's productivity, hence bring about what? Development. Imagine you have people who do not wait for supervision in government offices, people who are committed to work in government offices, people who use initiative in government offices. Don't you think they would have come up with a plan of connecting rivers so that we can eradicate the issue or the challenge of load shedding? So this is also important. We need to have positive work culture. Positive work culture. Thank you very much for joining today's class. It has been your perfect tutor, Mr. Gilbert CJ, and this is the end of our topic, economic and social development. We'll start a new topic in the next video. See you next time.